today we're going to talk about what to do to make a smart move with your current home when using equity from the current home to buy a new home. Hello, this is David Xie with the Xie Mortgage Team. I always talk about wealth and building wealth through multiple investment vehicles, whether it be houses, whether it be putting money into investment vehicles such as stocks, bonds, mutual funds, 401ks, TSPs, other assets. And one of the biggest data points that have come out recently to kind of support what I'm getting ready to talk about is the fact that the National Association of Realtors literally just came out and said, hey, the housing prices have dropped for the first time since 2012. So for the last 12 years, we've basically had the housing market going up and not doing this number up and down, up and down, up and down. So there's no other time to purchase a home than now, and this is how we're going to do it. If you have a current home, and we're going to learn how to take the equity out of the current home to apply towards the new house. What is equity? Number one, what is equity? Equity is the value of my house versus what I owe on it, okay? And that's the difference, okay? So let's just say you owe $100,000 on the house and it's worth $250,000. Then you have $150,000 worth of equity that can be used to either put down on a new house, pay off debts so that you can qualify for a little more when purchasing another home. And right now, you know, if you look at it, yes, rates are a little elevated if we compare it to the last 5 or 10 years of interest rates. However, if we look at a longer term, we're going to see that the average rate is probably right around where we're looking at right now, okay? So, you know, whether you borrow it out as a home equity line of credit, which is just basically an open line with your house as security, or we take it out as a cash out refinance, it's typically cheaper to do while the home is still your primary residence. The way that we can kind of do a comparison to see what makes the most sense is we look at your current interest rate on however much you owe. And then we look at the amount of equity that you're looking to pull out. And what we do is when we combine the two rates together with the interest rates, we're looking at a blended rate. It's not always best to go with either a home equity line or a cash out refinance, because obviously when a home equity line is taken out, that typically goes in second lien position. And no one likes to be in second lien position because there's always a first mortgage and first lien. So those are going to be typically higher rates. Whereas if we were to take cash out on a first mortgage only, then the interest rate's going to be lower because it is in first lien position. Another benefit of doing this is basically having someone pay for your mortgage, okay? Whether it's the house that you're going to be taking the equity out of or the new home that you're purchasing for investment purposes strictly by using the equity from your current home as a down payment, you're having someone pay down your mortgage payment. And with rent prices going through the roof, you know, I just talked to someone in Northern Virginia today in a little 2-bedroom apartment that's not even the best parts of town. Is $2,000 a month. You know, if you go to California, it may be even higher. Different states that with higher cost of living, it's always going to be higher. Having someone basically live in your house at a additional premium over an apartment is always going to be a plus and good from the investment standpoint, because what's typically happening when you rent out your house is this. You take out a mortgage at this amount and you have no cash flow right now. Every single month when you're getting cash flow from the renter, now you've got something that's either equal to your current mortgage payment or even higher. But what happens every single month when that mortgage and that rent is being paid to cover the mortgage, your equity increases and your monthly mortgage balance decreases. So when that happens, it typically leads to something that's even better than compounding interest. And that's gained equity that you could use towards other investments. And that's typically what the BRRRR method is, right? You're buying a house, you're rehabbing it, you're renting it out, you're refinancing and taking the sweat equity out, and you're repurchasing another property. And that's how a lot of people have really turned something that's really small as an initial investment into something really big. The next benefit is the tax benefit that comes with this. So anything that's secured with real estate is typically a tax benefit. And whenever you have income, you always want to have some sort of offset of income, whether it's be personal property taxes, state taxes, federal taxes, any type of depreciation or write-offs. Those are typically really good. There's also like really high level advanced tax benefits such as a 1031 exchange. And that's where you're taking one like kind exchange and you're exchanging it into something else that's also a like kind. So maybe a long-term rental into another long-term rental. You can also do cost segregation, which is accelerating some of the depreciation on some of the things. And then, like I mentioned earlier, buying something that needs some work. Let's just say you buy a house that's worth $250,000 and you're able to get it for $150,000 because it's in really distressed shape. Then maybe you could go into it, put $50,000 into it, and then walk away with $50,000 worth of sweat equity. It's always, if we look at it, I always think that this is definitely a safer investment vehicle versus other investments such as things that you can't control, such as stocks and bonds, because we all know whenever you buy anything like that, the person with the most money that exits first is going to be the one that typically makes the most money and can make it move the fastest. And, land is scarce. We had a lot of land and now houses are popping up all over the place and material costs are starting to come down, and so is the labor cost. So it's definitely the perfect storm when it comes to buying a home with the equity that you have in a current home that you currently own. What do we do with the current home? When we're taking out the equity, like I said, we can definitely, pay off debts if you were to sell it or, use the equity out of it. You can hold that as cash reserves. You can always use that for a rainy day, just in case anything happens with your current house or an investment property. You can put it into other investments, reallocate it into other things such as life insurance, such as the stocks, bonds, or mutual funds, maybe something safer like the S&P 500 index fund. You can use the funds to buy down the rates, whether it be a permanent buy down or a temporary buy down, so that you can get a little more affordability while we're waiting for rates to come down. And typically when rates do come down, that means your equity levels increase, and that's going to give you a great time to refinance and save you even more money, because then if you were to refinance and lower your rate, let's say from 6% to 4%, that's going to be a significant cost savings. And having that ability to not put that initial investment up front, to save it for, 12 months down the line, use it as cash reserves, and then if rates do come down, you're able to refinance, that's always a win for everybody. You can always put more down so you can borrow less. The other thing that you can do is you can borrow more on the mortgage loan by putting less money down, having that money in cash reserves, because when you borrow more from us on the 30-year term, even if it's at a higher interest rate, whether it be 5, 6, or 7%, your income or borrowing power is greater and the payback is less. So you're able to spread it out over 30 years versus going through a credit card and having to pay a higher interest, or getting an installment loan with a shorter term with a higher interest to pay that back. So there's a lot of benefits that we want to take advantage of while the values of homes are a little higher right now. And this is one of the ways that we can really take advantage of, the higher equity levels with, the perfect storm of like lower inventory and the higher rates. This is a great time to tap into the equity, whether it be a home equity line or a cash out refinance, to invest in yourself and your future. If you have any questions or concerns, my name is David Xie. I'm with the Xie Mortgage Team. I can be reached at 757-478-8493, and I'd love to talk to you about how you can take advantage of this. Talk to you later. Bye.